Welcome to the Real Estate Show on KMED. This weekend, Pete Belcastro, one of the real estate guys with you here today, and thanks for joining us this weekend on KMED. The Real Estate Show continues here, 8 years, over 420 shows, and boy, the topics just kind of roll along over these years and has the market, and the market, of course, has so changed from when we began back in 2009. We should talk nothing but about foreclosures and short sales. We don't even mention them anymore. That's how much things have changed around the real estate world. I'm a principal broker with John L. Scott in Southern Oregon, and we get together with you once a week here on KMED to talk about real estate issues and topics. Today, joining us, it's going to be an interesting show. We're going to talk lending. What do we expect from the lending industry in 2018? We've certainly gone through prognostications about everything else, it seems like, in real estate, so why not talk about what the future of lending is going to be? And Brian and Heather Case, our first kind of father and daughter team who's ever joined us on the Real Estate Show, are here today. And hey, thank you both for being here. It's cool to see you.
Yeah, you're welcome. Thanks for having us.
Thanks for having us.
I say Brian, of course, is with Guild Mortgage here in the Rogue Valley. And Brian, you've been doing this. Oh, well, I've been in 10 years, and you've been doing this. I know you were here when I was there, right?
I'm old. Yeah, I've been doing this 21 years here in the Rogue Valley.
21 years. So you've been through that up and down valley of this thing, haven't you?
Seen the cycles, absolutely.
Yeah. And you were saying that the lending industry, that we were talking about the number of new agents. There's lots of new real estate brokers, certainly in Jackson and Josephine counties. But tell me about the lending industry. Certainly the realtors have rebounded back. We certainly have not rebounded back in construction and skilled workers and things. What about the lending industry?
Like you said, realtors have bounced back probably about 100% almost from what they were at the height of the market. Lenders, only about 60%.
Yeah. So 10 years ago, there was like more than today.
A lot more lenders, absolutely.
Yeah. Well, it's interesting that it hasn't happened. And is it tough to become a lender? I mean, how do one become a lender?
It's tough to become. It's not necessarily tough to become a lender, but it's a very hard thing to do. We're responsible for everything and control nothing.
Yeah. Because you look to lenders big time when you're in a transaction. You have to have the lender. It's one of the partners in the deal. Well, Heather Case is here with us, and Heather, so you joined up with Brian then, right?
Yes, I did. I joined Guild Mortgage probably about almost 2.5 years ago now.
2.5 years ago. And you came from a media background, like Joe and I did and stuff. Did you ever think you'd be in this kind of business?
Absolutely not. My father's a lender. I said, I'll never do it.
You'll never do it.
And now I love it. So definitely a great opportunity to join a really strong team as well. I think as a new lender, that was really what made me succeed in this industry, was not being out on my own, but actually joining a good team.
I suppose if you're busy when you start, I mean, you really learn quickly, don't you? I mean,
absolutely.
You just do. Yeah.
Absolutely.
What's the hardest part about the lending industry? Because you're new. I'd love to hear. What do you think it is?
Our rules are always changing. So once you learn something, it's probably going to change. So it's just staying on top of what we are able to do and what we're not able to do and how we calculate certain things. It's just quite the learning curve, and that's always important.
It always changes.
Yeah.
I was just with Glenn Cunningham, who's our CPA, who joins us once a year on our show, and you talk about something changing is the tax world.
Exactly.
Whoa. And that's just like insane what's going on there and all the different rules and things like that. But they do change in the lending industry a lot.
Yeah.
And I think it's probably been good. Before we talk about some of what to expect this year, I'm curious as to give us our listeners your perspective. I mean, here we are. It's towards the end of February. It's winter, kind of spring, kind of like weather outside. But tell me what you think the market has been doing in your perspective as a lender.
As far as rates or volume or both?
Okay, start with whatever one you want.
Okay. Well,
rates we know are kind of inching up a little bit, but they're still historic lows. We talk about that all the time.
Absolutely.
Let's go to the other end then.
So with the loan volume that we're seeing right now, you're seeing some of the overall market dropping because as rates go up, refinances drop off. So that's really what's driving the overall mortgage industry to shrink in volume. I think from 2016 to 2017, it went from 2.1 trillion down to 1.7 trillion. So it was an actual drop. But the good thing is the purchase market is still very strong. So while the overall volume went down, for instance, at Guild, our purchase volume went up 19.2% during that time that the overall market dropped.
Okay. So when people are looking today and they're looking for loans right now, what are you telling them as far as the rate range and where are they coming from now when you see your clients? Are they local folks? Are they out of staters? Or what's kind of the big thing right now?
In my opinion, we have a combination of both. You have, for your first-time home buyers, your young couples who are trying to get into their first home, their starter home, their get in the market home, as I call it. Then you have a lot of people that are moving from Southern California. They're moving up here. They're the ones that are buying those higher-priced properties, up in the high $300,000 to $400,000 properties because they have the income. They're trying to downsize and get out of the expenses of California, move up to Oregon. But in regards to rates and stuff, I mean, as you talked about, it's just it's an ever-climbing hill upward. A little bit, but I mean, right now, about a year ago, they were low 4s, and
they were.
I'm always telling them, don't wait. I mean, I don't see the demand easing in our market very often, and with rates inching up, the longer they wait, they're just going to end up paying more to own the same house. So, and with rental rates as high as they are, I always have a saying: you're paying a mortgage, it's either yours or somebody else's, so you might as well be paying your own, right? So you might as well get in there before those rates start to climb, because every half a point, I mean, that can add up over time.
And so when that happens, is that some people are dropped out of the market, right? As the rates go up a quarter point. I mean, some people then don't qualify. Is that right? The qualification process that you go through today, is it pretty good still? I mean, you've been around longer than I know Heather has been, but because you were there, are you kind of satisfied that when I ask stupid questions like that the market, that your lending practices are pretty solid around the country?
They really are. What happened during the big crash, it got so ridiculous. It became kind of fog a mirror, get a loan. I mean, it was,
that's what it sounded
and you
like,
could make up whatever income you wanted to qualify. And people always thought, well, hey, the value keeps going up. If I get in trouble, I'll just refinance and get out of trouble, and then real estate always goes up. And while that's true over the long haul, we were in a bubble there because it was artificially inflated by income that didn't exist.
Okay.
And so,
Heather, if we have 9% increase in our values overall in Jackson County, or I think it was, and 7.9% in Josephine County just this last year, 2017, how does that affect lending if I come to ask for a loan when the values are going up? Does that affect anything about that?
I think it affects your first-time home buyers because you have those couples that are, their household income isn't quite high enough, or they don't know how to manage their debt properly, so they're coming in with a lot of credit card debt, so debt-to-income ratios are too high. Okay. So they're needing to qualify for move-in ready homes that are now priced out of that $100,000 range. They're now up in the $230,000, $250,000 range, and they're just struggling to get to that price point. So they're stuck in those low prices of $150,000, $175,000, where most of those houses need rehabilitation that they just can't give to those properties.
36% of the market nationally are first-time home buyers. Now, remember, first-time home buyer is anybody who hasn't owned a home for 3 years. So it's not like, think of young couples. So it's a lot of people. But still, 36% of the market falls in that. Are there still programs out there to help first-time home buyers as there was, or are they pretty much on their own trying to get into that first home?
No, there's definitely programs. I mean, for example, at Guild, we have a 1% down conventional program, which is awesome. It's a grant program specifically designed for first-time home buyers who meet income requirements and have decent credit scores and that type of thing. And that actually allows them to get in with only 1% of a down payment.
1% down.
Yep. Guild gives them a grant for the other 2%, so it's a 3% loan.
Whoa, come back. Gives. You give a grant of 2% of the purchase price?
No strings attached.
No strings attached.
Really?
It is awesome.
Wow, I didn't know that. Okay, so that's so 1% down though. If you qualify, what is the high income level on that? Do you know what that is?
Well, it's based off 100% of the area median income in Jackson County, which in Jackson County is $53,600. So, but it's also based off qualifying income. So, for example, if you have a household that collectively makes over that, but you have one borrower who meets those income requirements and can qualify for the purchase price you need, you can still take advantage of that loan and just say have a spouse or partner buy the property on their own with them only being on the loan, and then they can share title with their partners.
And there's some small pockets around Medford where there's no income restriction on that.
Interesting. Well, that's an interesting part of for first-time home buyers. And of course, RVAR, the Rogue Valley Association of Realtors, has a program through Access.
Yeah, they have a grant
program, and we've had people in here who have had up to $7,500 towards closing costs and down payments.
Yeah.
How do you handle closing costs? That can be in a transaction. when we get realtors together, you talk about different things in closing costs with buyers and sellers. Boy, they see those two things really differently, don't they, today?
They do.
In this market. It can blow up more deals right now is over closing costs.
Yeah, what we see is people can make monthly payments, but what they're having challenges with are saving enough money for either a down payment and to cover those closing costs.
Right.
So if they can't get a gift or something, then it's really easy for them to, well, I shouldn't say it's easy.
Right.
But sometimes we have to ask the seller to pay those because it's the only way they're going to be able to get into that home because they have to use their cash for the down payment.
Now, sellers, on the other hand, I have sellers who say, well, why should I do that? It's a seller's market. I don't want to pay their closing costs. They can come to it themselves, or the next person is going to come and pay their closing costs. That's what the sellers are saying, right?
Sure.
And it's funny because I do a lot of the pre-approvals for Team Case, and it's very few and far between that I have a borrower who's coming to get pre-approved who has actually the liquid assets to pay their down payment and their closing costs.
Okay, interesting. Okay, yeah.
It's
That
just
in the first time.
in that first-time home
First
buyer.
time,
Yeah,
right,
those
right.
second-time, those move-up buyers are different.
Sure,
but
yeah. So you're helping them that way then.
Yeah, well, we try to, and that's just us communicating with their real estate agents or communicating with them thoroughly and just saying, we can try. I would suggest you trying to see if the seller will help you pay for those.
Yeah.
And sometimes it's that renegotiation of price too. I've seen a lot of the times where a seller will counter with a higher purchase price just to offset the fact that they're paying for those costs.
And if you're going to do that from a buyer standpoint, and I understand this, if you are going to ask the seller to pay the closing costs, then you pretty much need to pay the seller's price.
Exactly.
To do that.
We set them up for that. We're like,
You do
hey,
that?
you're not going to be able to negotiate price and then ask them to pay for it.
Right. I mean,
in
the
this
worst thing you're going to do is say, well, I want $10,000 less than the asking price, plus you pay the closing costs. And boy, that's going to just kill the deal there. It just seems the sellers are not going to do that. I haven't found anyone who wants to.
And we refer them back to the experts, which are you folks in the real estate community, because you might know, hey, this particular property's been on the market for 200 and something days, so I don't know what the deal is, but they might be anxious to move that, right?
Yeah,
so
absolutely.
we try to put them back to you guys as the real estate professionals to do negotiate.
How difficult are you finding about contingent sales? All right, because the lender, you're into that thing. I mean, we have all these issues out there. And by the way, we're talking with Brian and Heather Case from Guild Mortgage Day on the Real Estate Show about lending right now. This show today is presented by the Rogue Valley Association of Realtors, of which these two teach classes to realtors. And so we want them here to tell us about, to tell you in terms about what they're telling realtors. Oh, I forgot what I was talking about there. What was I saying?
Contingent sales.
Contingent sales.
I
mean, that's contingent sales. I mean, you go in and you better have. I mean, how is that affecting lending? How are you dealing with your customers about contingent sales? Whether it's the buyer contingent on a property being sold, or the other side, which we start talking about more and more of, the seller can't sell it until it's contingent on them finding another place.
Well, it's a seller's market right now, so we usually let them know that contingent offers are not accepted very often, if at all, in this market. So
unless you have your place in contract with somebody,
exactly. So
if you don't, I would just say don't even make them an offer. Don't even make the seller an offer.
So what we do is we try to qualify them off of both mortgage payments and say, look, you could purchase this other home without selling yours if you have enough income to qualify for that. And then when they sell their home, we service their own loan, so they can come back and then do a principal reduction on the home, on the loan on the home that they bought, and have their payments reamortized for like $100 fee rather than having to refinance. So again, it does take somebody that has enough income to qualify for both of those mortgage payments.
I wish the lending industry in that particular area would somehow be more lenient. I don't see what I'm saying? Be more lenient, which is what I was against when we first started. But somehow to help people in those areas, because it would certainly move more inventory available. Because and I don't know what the answer would be there, but. It's really a problem.
Well, they used
contingent offers for everybody, both for buyers and for sellers.
Yeah, they used to do bridge loans a lot, but it's really hard to find anybody to do a bridge loan anymore. And that's where they would collateralize.
Cover you, right?
Exactly. It would cover you in the
interim. Until you were able to sell it.
Exactly.
Because most things will sell.
Right.
I mean, it'll sell eventually.
But when that crash happened, those bridge loans are in second lien position, so they took a bath. But
how do you handle? Because still, in Jackson County, surprisingly to me, 10% of it's a healthy market when 10% of your sales are foreclosures, as I've always been told. So that's where we are in our market. But how do you handle foreclosures then? Do you deal with any of those kind of things at all, or do lenders not even want to touch them?
It's not the fact that we wouldn't touch them. As long as the property can appraise, then there's not a problem. What I usually tell first-time homebuyers, though, is a lot of the times the property that's in foreclosure or that's been foreclosed upon, it's now bank-owned. The bank's not going to pay your closing costs. You're probably going to have to come in with all this cash to close. Okay. Depending on how long it's been sitting there might be repairs that an appraiser is going to be required to complete for us to fund on the loan. And if appraiser calls out that repair, it has to be fixed. So I always tell them, depending on that's where they go back to their real estate professional and look at the structure itself and how decent that property is. But it's not that we won't touch them.
We treat them just like a regular seller.
It's just like a regular home.
You would treat them so it's really, but it's the condition of the property.
That's
some are in obviously better than other conditions as you go, but they still make up, again, 10% of the market, and sometimes you can get a good deal on them for sure.
Absolutely.
We got a break coming up here today. We're talking with Brian and Heather Case from Guild Mortgage on the Real Estate Show today. Today's show presented by the Rogue Valley Association of Realtors. We're going to break. Coming right back, we're going to continue talking about lending. Real Estate Show comes back right after this. Real Estate Show continues here on KMED this weekend. Pete Belcastro with you. Joe's off this weekend. Be back next weekend as well. Got some terrific shows ahead for you. More John L. Scott Market Watch shows. So Ready will be with us in a few weeks, by the way, to talk about generally the economy here in the Valley. When we have an economy and there's jobs and things are moving along, the ripple effect in the real estate market and industry is certainly being felt, and that's what we see right now. Today here on this show, Brian and Heather Case from Guild Mortgage are with us. Today's show presented by the Rogue Valley Association of Realtors at roguevalleyrealtors.org. Don't forget. And by the way, in March coming up, they've got the big Rogue Valley Food and Wine Classic. And next month, we'll talk about that, which is their big event, which supports the Home Foundation, which supports the First-Time Homebuyers program that we've been telling you about for some time. So that is all ahead for us as well. Well, anyway, Brian and Heather are with us. And, one of the things that's so interesting to me that the market is that it's different in different locations. Yeah. I mean, East Medford is certainly the largest of the areas, but it's different there in Ashland versus, Shady Cove, Eagle Point, whatever. That's really kind of odd, isn't it? It's interesting, isn't it?
Mm-hmm. Yeah, absolutely.
Yeah, and I don't know how it's going to change or whatever. Does that when you lend, you get appraisers? How is that part of your business gone? Because we've had appraisers here with us. Are you seeing appraisals coming in, or tell me where that stat is used, the lender, because they basically you hire them, right? You're the lender.
Well, we have to go through a third party
vendor. Yeah, okay.
So they don't technically work for us, and we can't even pick which appraiser goes out to which property anymore.
Okay, that was the clarification I was waiting for. They say that about the new world that came after 2007. Okay.
So we have had some appraisals that have come back a little bit high because some people in a seller's market, they get a little bit unrealistic, right, with the sales price, and and maybe they list it way above market. It doesn't mean that they still don't sell the house at that price. People are out there looking in the market, and with a tight market, if it appraises lower than what the sales price is, 9 times out of 10, they're going to try to renegotiate that price.
Okay.
But if a buyer's been out there and they go, hey, this is the house I want. I've been looking. I'm tired of looking. I just want to close this. We've seen them pay above the appraised value to purchase that home.
They can do it either way, right?
Mm-hmm.
Absolutely.
And if you wanted to do that, buy it above the appraised value, you're not going to increase the loan, right? They have to do what, Heather, to do that then?
They have to come up with the difference in the payment. So
they have to come up with the extra cash.
They do have to come up with the extra cash.
So it might be $5,000 or $1,000 or whatever that is. Yeah. They have to come up with that, but you would still make the loan.
Yes, for whatever they were approved for.
All right.
Yeah.
Tell me how you deal with rural properties. In the last MLS stats for November, December, January, we had a little bit fewer rural properties sold, and even the value, the interesting part, the value went down, over the previous year. The median value went down by 1.5%. Things have changed, okay? Tell me how you're dealing with rural properties today, with all the cannabis that's out there and things that are, that whole craziness that's out there with that.
Well, we're getting a lot less calls.
Less calls.
Less calls. We used to get a lot of them saying, "Hey, we really don't care about the structure too much. We just want something on a south-facing slope and
with some irrigation water and EFU."
EFU land,
right?
Exactly.
EFU land.
But then got so overbuilt. It's the old theory of supply and demand, right?
Yeah.
So now that the bottom has dropped out of that market as far as retail is concerned for the product, obviously people aren't willing to grow anymore.
Well, now I've seen. You're right about that, Brian. And I've seen on the MLS, I swear, in the last couple of weeks, at least 3 properties that have been listed as grow properties, and they say it right on the marketing remarks. One of them was $2.2 million. They ranged their net price at the high end down to around, I think it was $500,000 for one that I saw. But if I want to buy it, okay, so I'm coming in to buy it, and I don't necessarily want to do that, but I want you as the lender to, someone's going to come out, say, Brian, I come to you guys. Tell me what happens with that. What's the story with that?
Well, that market is still federally legal. So if for conventional standards in regards to lending is we can't know it's there.
So yes, okay. I mean, even though the state of Oregon has legalized it, even with the medical marijuana card, federally it's illegal and it's considered money laundering if we actually finance that.
But if someone comes out there and wants to buy one of those properties, they're going to be coming up. I think we're going to see a whole bunch of them come up in the next couple of years. Myself,
they're going to be paying cash or they're going to get private money.
Really?
Yeah, they will not get financing from a federal institution.
So if an appraiser comes out there and sees any of that, then they're done.
Yes.
So they would have. So what we're saying then, I guess, is that they would have to remove all evidence, I guess, of any cannabis grow before you could put a loan on it.
Absolutely.
Correct? Okay. Let's talk about manufactured homes for a minute. So this is really good that you're here with, because these are all things that so many people come up with and ask questions about. I get so many people ask about why can't lenders loan like you do on a regular home, on a manufactured home in a park? Because why not? I mean, the demand, Brian, is so great there. I know they don't own the land underneath it, but is that the only reason?
So you're basically financing a car at that point. Think of it that way, or an RV. Because
even though they're more permanent structures and they're not going anywhere,
because we can't foreclose on it. Because if we foreclosed on the manufactured home, we'd have to yank it from the lot because we don't have own the land that it's actually under. Take legal ownership of property,
it's not real property.
Exactly.
But there's no lending with that. Someone ought to start that business or something, I think, because so many people, mostly older people, who are looking for places to go, would love to be able to finance something like that, even for a short period of time, maybe. I don't know, but it's heartbreaking. It's heartbreaking that you tell people you have to have cash to do a manufactured home. Okay, so you can't do that, period.
Not
but
if they don't own
tell me about the rules you have. What about a manufactured home on land? Well, what's that? How do you deal with that?
They have to be built at least after June of 1976, because that's when HUD started regulating them. Have to be at least a double wide or larger.
Okay.
And we can do them on conventional, FHA, VA, all types of financing.
As you do regular places.
As long as it's an owner-occupied or a second home. There's no investment financing. So if you want to buy one as a rental, unfortunately, there's not a market for that currently.
All right. What if I want to invest now? If I want to invest in a duplex or just another home for a rental or I would say even a vacation rental or even a second home? I guess all 3 of those kind of count, don't they? First of all, has the new tax law that went through, has that dampened that type of thing? Or tell me what you've experienced with that.
No, I haven't seen that dampen the desire for that right now.
Okay.
No, again, you can still deduct mortgages up to $500,000 for your primary, and again, you can still deduct expenses on a rental property. I think it's a great way to still build passive income. Here's something that I think a lot of millennials, so first-time buyers, should look at. With an FHA loan, you can actually buy up to a 4-unit property and still only put down 3.5%, and you can use the income from the otty 3 units to help qualify for that mortgage. So
you can use the other units to qualify for the mortgage as the income coming in.
Absolutely.
Yep.
Oh, that's pretty interesting. But there's not a whole lot of 4-unit out there, are there?
No. You can just say with a duplex or a triplex.
But a duplex or a triplex, even so, maybe even. Well, in many people, you're right. You have a duplex, you live on one side, and you get rent from the other side. That's a good way to start because you got to start somewhere. And we know that the value, a person's personal wealth increases so much more when you own something. You own property versus just being a renter. because your money just goes away every month,
Absolutely.
And somebody else gets the deductions.
There you go.
And things like that. So vacation homes, second homes, you're both saying that those are still, people are still looking at that, and that's not changed much.
Yeah, and some folks are buying them, and then if you buy a second home, we had one over on the coast that we purchased, and as long as you live there 2 weeks out of the year, it's considered a second home, and then you can still put that on a vacation rental or
Are you
Airbnb
seeing more interest in vacation rentals or short term? I guess travelers accommodation properties that are out there. I certainly am seeing that in my end of things. You seeing that too?
Yeah, I think so. I think that's where it comes back to that conversation of you can buy it as a second home instead of as an investment property, as long as you live there 2 weeks out of the year.
2 weeks out of the year, and that's what it would take to do.
And then we're seeing that a lot in Jacksonville and Ashland. They're big on those seasonal rentals.
For Airbnbs.
Well, I'm telling you, I think that here in the next few years, you're going to see North Main, Siskiyou, and East Main just be nothing but travelers' accommodation places.
Probably.
They really are. I mean, the demand is huge for these, and I know people converted rentals to them, depending on their location and all those kind of things. You can make more money than you can the other way.
Exactly.
It's an interesting market. And we're with Brian and Heather Case here today. We're going to talk about borrowers of the future. What are millennials going to do? What's this going to look like in the future? We're coming right back. The Real Estate Show continues here on KMED right after this. Real Estate Show continues here on KMED this weekend. Pete Belcastro with you here today. Joe will be back next week with us. Don't forget, you can check out any of our past shows at realestateshoworegon.com. They're there for you to watch again sometime. Some terrific shows we've had, anything from 1031 exchanges. I love those things. You're talking about getting into something really cool there. Construction, new construction, and just a whole lot of great shows there. So please check them out with a terrific group of guests, as you know, like today. Brian and Heather Case from Guild Mortgage are here. Today's show presented by the Rogue Valley Association of Realtors at roguevalleyrealtors.org. They provide the multiple listing service that goes out basically all over the world. Whether you're on Zillow or Realtor.com, it comes out of the MLS, which is all part of the Rogue Valley Association of Realtors. Brian and Heather Case are lenders from Guild Mortgage. We've been having an interesting discussion today, folks, about lending around and what's going on. Here, this last segment, borrowers of the future. You brought that up. It's a great topic. I love that thing because, look, the way I grew up, I'm older than all of you, both of you. So, okay, so the way I grew up, we had big families and we had lots of that. I guess it was the nuclear family then, wasn't it, back then? And you're younger than me, Brian, and it was a little changing. And by the time Heather got here and Heather's kids, the family, everything is different about how we live and in our housing needs today, right?
Exactly.
Yeah.
So borrowing in the future is going to somehow got to change to meet this new kind of life, right?
Yeah, I was just down at a leadership summit in San Diego, and they're talking about the borrowers of the future, the millennials that maybe want to buy a home, but they want to rent out 2 of the bedrooms to friends of theirs, But how can we accommodate that? Or extended families. You've got a lot of elderly parents now that want the kids to move in too, and so they want to move in and live together, but still have separate spaces. So how can we accommodate that more?
The mother-in-law cottage.
The mother-in-law cottage.
You hear that all the time.
Absolutely.
I want to add a room over here for the mother-in-law kind of thing.
Absolutely.
That kind of thing. Do you do lending on that kind of stuff? If you wanted to add a remodel house, do you do that kind of thing?
Yeah, we can do that. We certainly do that now.
You do?
Yeah,
okay.
Absolutely. But it's some of it's too about how do we integrate their incomes together to qualify for the house that they want to. For instance, now you got a lot of people driving for Uber, right? So how can we use that part-time income to help them qualify for the houses that they're living in?
And can you do that?
You can if they've got. Normally, they need a 2-year history of doing that, but they're trying to look at those different facets because now people might have a main job and maybe even 1 or 2 other part-time jobs that they do sporadically. How can we average that income in there without having the normal 2-year history of receiving that in order to qualify?
So what else are the borrowers of the future, millennials? I can't think of. They're out there and they're buying. People are buying stuff. Young people are buying houses, right?
Yeah, I think so.
Yeah.
I think that there could be more young people buying houses. I think that a lot of the time it's, a millennial myself. I have a lot of friends and people that I know who say, I don't know if I'm ready to buy because I don't know if I'm going to settle down here. And I think that that's a false assumption because I think, are you going to be here for 2 to 5 years? Okay, great. So do you want to pay someone's rent for 2 to 5 years? Or you don't build equity in yourself. So then when you do move, now you sell and you have either cash to buy a property in your new place or just money to help
Or I
you
think a
make
lot
that
of them
move
that
too.
don't even think they can qualify, and
It's a lack of education,
They
I think, too.
just don't think they can qualify.
Yeah,
But they're out there with jobs and working,
Absolutely.
right? But their lifestyles are different, right? And their needs are different. But can you buy things? People could buy things together. I mean,
we do a lot
kind
of
things.
even non-occupant co-borrowers. So if you've got a kid that's going to college or something, and mom and dad are helping him out, they can still buy it as a primary residence, and get owner-occupied rates. And,
They can buy it as never. What's the rule we have on our show is never co-sign with your children.
There you go. And that's what so they can actually buy it themselves as a primary.
I was just going to say what you said was the way to do it. The parent buy it for the
Absolutely.
Buy it, okay. But just don't co-sign alone with your child.
It usually
don't
doesn't
ever
end
do
well.
that. Student loan, it doesn't. Well, we get lots of histories over that kind of thing as well.
Right.
What other things are millennials going to, you think, demand in the future in lending? What do you think What do you think their needs are?
I think it's just a matter of how simple can you make it for them. Millennials, we want stuff and we want it now. And we just want to be able to give you stuff and be done with it. I think that those things in regards to how can we make it easier for the borrower, how can we collect more of their documentation without actually needing them to collect it for us. So systems like that, to where they can get online, fill out the application, they can give us access to be able to pull pay stubs from their employer, order verifications of employment, those kind of
nice,
things.
Wouldn't it? Yes.
So that way really the only thing that they need to do is DocuSign their documents, basically.
That's kind of like a realtor does. I mean,
Exactly.
with that, and you can.
How can we make it less stressful on
yeah.
them with gathering that information? Because I think if we can streamline those
And
avenues,
that technology is there, and it's being
there.
refined,
Is that being
and it's
developed
coming
now?
out.
Wow.
The challenge we have is we have the younger generation that's all about that.
Well, they're
but then
all
you have
on
the
that
older
the
generation
electronic
that's
world
going,
anyway.
"Hey, I'm not giving you access to my information."
That's what I mean. The needs are different.
Exactly.
As we go through different generations. But I think the thing you talked about home buying, they say I'm going to leave. The reason I don't do it is that I made sure I stay here. I've had many friends in the media over the years, and the smart ones I always realized were the ones who came in, even they were single people, they bought a house the first time, and then they always bought a better house the next time when they sold the one to move to the next place. And over the years, they built up a great number of wealth to have vacation home, etc., because they were buying, even though they moved 5 or 6, 7 different times, they were able to buy a house each time and do that.
Exactly.
And that's how you create and generate wealth, is to do that kind of thing for yourself, right?
Well, you're constantly investing in yourself at that point. Instead of, like Brian said earlier in the show, you're not paying somebody else's mortgage. You're investing in yourself.
Yeah. So let me just think. For 2018, you both think that this market here is going to continue. I call it robust. It is. It's different for It truly is different for buyers than it is for sellers.
Sure,
we know
absolutely.
that. So so when I say how's the market, it's good. Well, it depends if you're how good it is, but it depends if you're buying or whatever. But there seems to be somewhat more inventory, although the statistics didn't bear that out. There's still less than 1,000 homes on the market in Jackson County. That simply makes it overall
it's still
a
supply
seller's
and
market.
demand. There's still more demand than there is supply. So I think, and again, that's the trending. What the economists are expecting in the mortgage industry is, again, the overall mortgage volume to drop, but the purchase volume to increase. And it's just because refinances dry up. We see a very strong housing market going forward.
And are you seeing a lot of refinancing in your area too? People doing that a little bit again, or not?
We're still doing some, but it's slowing down. As rates tick up a little bit, it becomes less attractive to do so. However, people have more equity now, so some of them are doing those refinancing to get some of that, the money to remodel or to do some improvements that they've been holding off on.
Well, it's certainly been a different market with equity for people. Like 98% of Oregonians now are above water.
Exactly.
I had clients who bought it in 2007, just now are above that, and are able to sell their property finally and not lose money on it, things like that. So there's lots of positive things out there, and it's certainly the demand, I agree with you, is not going to lessen out.
One of the best opportunities right now is for people to sell in that low end and buy at the high end right now. I think that's one of the best opportunities.
You can find you at Guild Mortgage, so Brian Case and Heather Case. So thank you both for being here.
Absolutely.
So come back again. We'll do it
Thanks
again.
for having us.
Wonderful.
All right. Today's show presented by the Rogue Valley Association of Realtors. That'll do it for the Real Estate Show this weekend. Have a great week, everybody. God bless you all. We'll see you next weekend right back here for the Real Estate Show.
You've been listening to the Real Estate Show on KMED Radio. Show, presented by the Rogue Valley Association of Realtors, along with John L. Scott Real Estate of Southern Oregon and Bank 34 Mortgage. For guest contact information, download our free app, or to watch a past show, visit us online at realestateshowOregon.com. This show is produced by Table Rock Productions. Join us again next weekend for Southern Oregon's one and only real estate show on KMED. And thank you for making the Real Estate Show part of your weekend.